All right, welcome to day 2. Yesterday, we got our bearings and laid down the foundation. Today, we start building the skyscraper. We're going to move past the basics and dive right into the core skills that really give professional traders their edge. We're going to master how to read the market's direction, figure out its strength, and most importantly, confirm the absolute best moment to act. So, let's get right into it. So, you have to ask yourself, what really separates a professional from everyone else, right? Is it some sort of secret formula? Do they have a crystal ball that tells them the future? No way. The answer is actually a lot more disciplined and a heck of a lot more reliable. And here's the absolute key. Professionals don't predict, they react. They have a system, a repeatable process for confirming what the market is actually doing right now. Think of it less like a fortune teller and more like a pilot running through their pre-flight checklist. Every single item has to be verified before takeoff. And that very checklist, it's built on these 3 pillars: trend, momentum, and confirmation. So our mission today is to master each one, and we have to do it in this exact order. Why? Because this is the sequence every pro follows before they even think about risking a single dollar on a trade. Okay, first up, pillar 1, reading the trend. Before you do anything else, you have to know which way the river is flowing. And this isn't about guessing. It's about establishing a clear, objective directional bias. Are the buyers in control, or are the sellers calling the shots? Now, one of our main tools for this job, especially in a fast-moving market like crypto, is the exponential moving average, or EMA. See, unlike a simple average that treats all data the same, an EMA gives more weight to the most recent price action, so it reacts much faster. It's kind of like a dynamic, intelligent trend line that hugs the price. And we use 3 of them. Think of them like different lenses. The 200 EMA, that's your telescope. It gives you the big picture, long-term bias. The 50 EMA is your mid-range lens, showing you the main prevailing trend. And the 20 EMA, that's your magnifying glass, zeroing in on the immediate short-term moves. When you put them all together, they tell you a complete story. And here are these simple but really powerful rules for rating that story. If the price is trading above the 200 EMA, our overall bias is bullish, period. If that short-term 20 crosses above the midterm 50, well, that's a huge sign the bullish trend is getting stronger. And when you see all 3 fanning out and pointing up, now that's a market with clear, undeniable direction. But listen, indicators only show us the bias. The ultimate truth, the final word, is always in the price itself. This right here is a mantra you have to live by as a trader. It doesn't matter what your indicator is telling you. If the market's actual structure says something different, price action is king. So let's look at that structure. A healthy uptrend has this beautiful, clear rhythm of higher highs and higher lows. It's like the market is breathing in to make a new high and then breathing out to set a higher low before the next push. A downtrend is just the opposite. Real confirmation happens when price breaks through an old ceiling, a resistance level, and then comes back down to prove it can stand on it as a new floor. That's the heartbeat of a healthy trend. Okay, now we're ready for our second pillar. We figured out the trend's direction. Now we need to measure its horsepower. Is the engine just getting warmed up, or is it redlining and about to burn out? That's the critical question of momentum. And for this job, our best tool is the Relative Strength Index, the RSI. But please, don't just see it as some squiggly line on your chart. I want you to see it for what it really is. It's the market's engine gauge, its tachometer. It tells us just how fast and how aggressively buyers or sellers are hitting the gas. And here are the key zones on that gauge. If you see it pushing up above 70, the market's considered overbought. The engine is running way too hot, and it probably needs to cool down with a pullback. Below 30 is oversold, where a bounce could be on the horizon. But you know what? The most important level is 50. In a strong uptrend, momentum should stay above 50. In a downtrend, it should stay below it. It's our momentum center line. Now, this is a bit more advanced, but it's so powerful. It's called divergence. This is what happens when price and momentum start telling you 2 different stories. Let's say the price pushes up and makes a brand new high, but at the same time, the RSI actually makes a lower high. That's a bearish divergence. It's a subtle clue that the strength behind this move is fading, even though the price hasn't turned around yet. It's a huge warning sign. And that leads us to this critical rule. You have to burn this into your brain. A divergence is an amazing clue. It's a hint, a whisper from the market that the trend might be running out of steam. But it is not a signal to trade. The final verdict always comes from price action. The real confirmation is when the market structure itself finally breaks. Which brings us perfectly to our third and final pillar, confirmation. This is where trend and momentum all come together. This is where we apply a strict, almost mechanical execution protocol. We're about to dissect the anatomy of what makes a high-probability breakout actually work. Look at this checklist. This is non-negotiable. Every single one of these conditions has to be met, no exceptions. I don't care if a candle wick pokes through a level, that means nothing. You need a full candle body to close outside. You need a big spike in volume to prove other people are jumping in. Price has to come back for a retest, and then you need to see it get rejected. Proof that the market respects this new floor or ceiling. And all of this has to happen while the overall trend structure and the RSI are still on your side. If you only remember two things from that entire checklist, let it be these two. A firm candle close shows commitment from the market. A big surge in volume shows conviction. If you don't have both, you are probably walking straight into a trap, what we call a fake out. Okay, so now let's put all three pillars to the test. Let's use these new skills to answer the single most important question a trader faces every single day. Is this move just a healthy pullback giving me a chance to get in, or is this entire trend about to roll over and die? This slide lays it out perfectly. In a pullback, the structure of higher lows stays intact. The EMAs are still fanned out nicely. It's just the market taking a healthy breath. But in a reversal, the structure breaks. All of a sudden you see a lower high in an uptrend. The EMAs start to cross over, and the retest totally fails. One is a sign of strength, the other is a 5-alarm fire telling you to get out of the way. And now it's time for your mission. Listen, the goal today is not about making money. It's about building a skill. It's about taking this theory and putting it into practice and really developing the patience and the discipline to wait for the market to give you all the confirmations we just talked about. And please, remember this always. This isn't just a nice little quote. It's the #1 rule of survival in this game. Your trading capital is your inventory. It's your business. The entire goal of these lessons is to help you achieve chart mastery, so you have to protect that capital fiercely by practicing until this process becomes second nature. So here are your orders. Go ahead and open up the Ethereum/USDT 1-hour chart on Bybit. First thing, put on the 200 EMA and establish your bias. Next, draw your most obvious support and resistance zones. And then, your job is just to watch. Wait patiently for a candle to close beyond one of your levels. When it does, check for that volume spike. Then watch the retest. Look for that rejection candle that shows the level is holding. Do this over and over without placing a single trade until it becomes completely effortless. And I'll leave you with this final thought. You can draw lines on your chart all day long, but they are absolutely meaningless until price proves they matter with a clear reaction. See, your job is not to predict where the market will go. Your job is to observe what it does. Wait for your entire checklist to be ticked off, and only then act with confidence. That is the path of a professional.